Hello everyone, John AG here, and I need you to understand what just happened because it wasn't a routine pullback. It wasn't profit taking, and it definitely wasn't the market cooling down. In the last 24 hours, the rules of the silver game were rewritten in real time, right as price pushed through a level that had the entire paper system sweating. Silver surged through the mid-80s. The global spread blew out, and then quietly, clinically, the exchange hit the lever that forces small traders to dump positions whether they want to or not. Now, before we get into the mechanics of it, let me ask you something. When a casino changes the table limits mid-hand, who is that change meant to protect? The players or the house? Because what happened overnight was the futures house raising the cost to sit at the table. Not next month, not after a vote, but immediately right when the market was heating up. And the timing is the tell. So here's the sequence in plain English. Silver ran hard. Futures traders piled in. Leverage did what leverage always does. It magnified the move and attracted more participants. The physical market stayed tight, premium stayed sticky, and overseas prices signaled that the real metal was worth more than the paper quote. And then the exchange that governs the main paper venue issued a margin advisory that effectively said, if you want to hold the same position you held yesterday, you now need more cash in your account today. That one change creates forced selling, even if nothing fundamental changes, because futures is not like buying coins and sticking them in a safe. Futures is a balance sheet game. If your account doesn't meet the new requirement, you don't get to debate it. You don't get to wait for a bounce. You either wire in more money or your broker closes you out. That is how liquidation is manufactured. And here's why I'm being dramatic about it. It targets the exact category of trader that can't instantly meet a surprise cash demand. Big institutions can post more collateral in minutes. Market makers can shuffle capital. Banks can rehypothecate and borrow against everything that isn't nailed down. But the smaller participant, the person who used futures for exposure because they don't have 7 figures sitting idle, gets squeezed out by design. Let S break down the math, because this is where the manipulation stops sounding emotional and starts sounding mechanical. One standard silver futures contract represents 5,000 ounces. If silver is trading around $85, that contract controls about $425,000 of silver. You're not paying $425,000 up front. You're posting margin, a performance bond, collateral that says you can cover adverse moves. Under the old framework, the margin requirement was a fixed dollar amount around the low $30,000 range. That's the lever. You could control a huge notional position with a fraction of the cash. Now swap that fixed requirement for a percentage-based requirement tied to contract value. One is a paper event. The other is a real economy event. So here's the cliffhanger you need to sit with. If they had to pull this lever now, what do they think happens if they don't? Because nobody raises table stakes in the middle of a hot run unless they re-worried about what the run becomes next. And I know some of you are thinking, okay, John, but maybe they're just being responsible. Fine, let's test that logic. If the concern is volatility, why is the rule change happening right after a breakout level? Why is it happening when retail participation is elevated? Why is it happening when the narrative is bullish? If this were purely about risk, you'd see predictable, gradual adjustments, not a surprise punch to the stomach. Now, here's where strategy matters. If you're holding physical silver, coins, bars, allocated storage, this margin stunt cannot touch your metal. It can only touch paper positioning, but it can influence the headline price, which can influence emotion, which can influence your temptation to sell. And that is the trap. The trap is believing the paper quote is the full truth. If you're trading futures, the game is harsher. You're playing inside their arena under their rules with their ability to change those rules. If you get a margin call, you're not being asked if your thesis changed. You're being asked if you can post cash. That's why so many people eventually conclude that futures is a place to trade, not a place to build long-term conviction. And if you don't own any silver yet, this is the question. Are you waiting for confirmation from the very system that benefits from you being late? Because the best moments in hard asset cycles often feel uncomfortable. The best entries rarely happen when everything feels safe. Quick break, because I want to do something different today. If you also like hearing about real silver-related success stories, regular people who use discipline, patience, and smart timing to build something, there's a link in the description to another channel that focuses on those wins. Go check it out and subscribe, because seeing what others did right can keep you steady when the screen turns red. All right, back to the battlefield. Let's talk about the bigger macro backdrop that makes this margin move even more revealing. There's a reason hard assets keep grabbing attention. The debt load is massive, the cost of money is unstable, and policymakers have a habit of choosing liquidity over pain. When the system strains, the reflex is to add liquidity. And when liquidity floods in, it doesn't land evenly. It tends to lift scarce real assets, especially the ones tied to industrial need. That's why silver is uniquely tricky for them. It's not just a monetary metal people hoard, it's also an input. It sits inside electronics, energy infrastructure, and high-tech manufacturing. You can shout speculation all day, but factories still need ounces. And when the industrial side collides with investment demand, paper supply promises start to look optimistic. So imagine this. You have a market where the paper price is pushed down by forced liquidation while the physical market stays tight and premiums dawn T-collapse. What happens next? Either the physical market loosens, meaning supply appears and premiums drop, or the paper price eventually has to chase the physical reality. That's the fork in the road. Now, I'm not here to tell you it only goes up. I'm here to help you see the structure. And structurally, when the exchange reaches for a margin lever, it's admitting the structure is stressed. So, what should you watch next? Watch whether the overseas premium widens again after the paper shakeout. Watch whether retail dealers stay sold out or start discounting. Watch whether delivery demand stays elevated. Watch whether the same talking heads suddenly scream, "Top is in" the moment price dips. Because narrative is a weapon. And here are 2 questions I want you to answer in the comments because I'm genuinely curious how you see it. First, do you think raising margin requirements during a breakout is legitimate risk management, or is it targeted damage control? Second, if we get another sharp dip purely from paper mechanics, are you personally a buyer, a holder, or are you stepping aside? Now, let me address the emotional core of this situation because numbers alone don't capture it. People feel betrayed when a market is run this way. They feel like the game is unwinnable. And that's exactly the feeling the system loves because discouraged people stop participating. They go back to passive indexes, back to yielding less than inflation, back to trusting that the rules will stay the same. But in hard asset cycles, the rules don't stay the same. The rules change because the system is defending itself. And that's why I keep coming back to physical ownership. If your goal is to trade, fine. Understand the arena. If your goal is to protect purchasing power, then the more paper your exposure is, the more permission you need from the same system you're trying to hedge. Now, one more cliffhanger before we wrap. If this is the first margin shift in this move, what happens if silver pushes higher again? Historically, the lever can be pulled more than once. The question is whether they can pull it enough times to break momentum without breaking confidence in the venue itself. Because if participants begin to believe the venue is hostile, liquidity can migrate. And when liquidity migrates, control weakens. So here's my bottom line. The margin hike is not proof the bull move is dead. It's evidence the move matters. It's evidence the breakout threatens someone. It's evidence the paper market is choosing enforcement over acceptance. And in my experience, that S usually a sign you are closer to the truth than the headlines want you to be. If you've made it this far, here's the simplest action you can take. Subscribe. Short, effective, and it helps you stay plugged in when the next emergency headline drops. And if you want to help this message reach people who still think markets are always fair, share it with one person who needs to see how the lever works. We're going to watch the next sessions closely. We're going to watch whether the dip is bought, whether the spread returns, and whether the physical market shrugs off the paper tantrum. Because the real story isn't the candle. The real story is why the candle had to be forced in the first place. Now, a lot of people ask me, what should I do if I don't trade futures? And I only watch spot. Fair question. Most of you aren't holding contracts. You're watching a quote on a phone. Maybe you have a stacked slowly and you just want to know whether this was a real breakout or a fake one. Here's how I think about it. Paper can slam price for days. Physical availability can lag for weeks. But eventually, real buyers show up, and that's when you learn what was noise and what was signal. If you're wondering why I keep saying discipline, it's because that's exactly what the system tests. Price isn't supposed to run. It's supposed to behave. It's supposed to move in ways that don't embarrass the institutions that sold more promises than they can comfortably cover. So the moment silver starts acting like a scarce commodity instead of a spreadsheet entry, the guardrails appear. Also, don't underestimate the psychological timing. A notice after the close, a change effective the next morning, and suddenly your chats are full of panic. That panic is a feature because panic creates sloppy decisions. So here's my challenge. If you believe the physical market matters more than the paper casino, act like it. Don't let a red candle bully you. Don't let a policy memo rewrite your conviction overnight. And one last cliffhanger. Watch what happens the moment price tries to reclaim the highs again. Do we get another emergency adjustment? Do we get a barrage of doom headlines? Or do we get silence while insiders reposition? That reaction will tell you more than any chart. And if you're building a position, do it methodically. Small buys, consistent buys, and never with money you can't leave alone. Stay calm, stay liquid, and keep your eyes on premiums. I'm John A.G., and I'll see you in the next